Hi, I'm Terrell Turner, the host of Business Talk Library. Now, this show is where we make sense of business because there are so many complicated conversations going on about business, but here we keep it simple. I was reading an article today about Wells Fargo. Now I'm a little partial because, hey, it's in my home city, Charlotte, North Carolina. Now, I'll read to you exactly what the article said. Now, it says, the headline is, Wells Fargo shares dip 3% on profit outlook. First paragraph, Wells Fargo delivered a strong earnings report on Friday, but its shares tumbled on a reduced net interest income outlook. For the first quarter, the bank reported the net income rose $5.5 billion or $1.20 per share from $4.7 billion or 96 cents per share. Revenue declined slightly, $21.6 billion compared to $21.9 billion. Now, analysts expected it to be $20 billion. So after reading that, you probably ask yourself, what does all that mean? And why would the stock go down? I mean, it sounds like they outperformed the analyst expectations, and it sounds like they had a really good quarter. But I'll give you a helpful tip. When it comes down to stocks, the price of the stock is all about the future. Now, one of the things they also talked about in that article is that for the future revenues, Wells Fargo said that they were going to reduce their estimate. Now, when you're looking out at the future and you say, okay, all right, based on what we've been doing in the past, we actually feel like some things have changed in the business or some things are not looking as good as we thought they were. So we're actually gonna tell people, hey, you know what? We actually think we're gonna be a little bit less profitable than we were in the past or a little less profitable than we expect it to be. And when you share something like that, always know that when the future does not look as great as people thought it was gonna look, or the future doesn't look as good as you thought it was gonna look maybe a couple months ago, that will have a negative impact on your stock. Now, again, I read all of it to you, and if you probably went out there and read it, you would probably say, this sounds like a lot of complicated conversation to explain something very simple. They had a great quarter. Their past results, they improved slightly, but when they're looking out at the future, things don't look as bright as they did when they first gave their estimates maybe a couple months ago. And because the future doesn't look as bright, hey, the stock price takes a slight dip. Now, all of that can change depending on how they actually start performing as the future unfolds. But always remember, when it comes down to stocks, the price of the stock today is based on what people expect it to do in the future.